Welcome everybody to our Trust Deed Masterclass, How to Read a Discretionary Trust Deed, brought to you live by Tax Nuggets Academy. Hello, I'm Joyce and I'll be your host for today. We have over 1,000 registrants today, so we just broke our little record since, Tax Nuggets started about 2 to 3 years ago. So it's going to be an epic event. If this is your first time Nuggets event for you, welcome and great to have you with us. Welcome back to our subscribers, our loyal Nuggeteers. Thank you for joining us today. As usual, the chats are open, so feel free to engage with us, engage with each other, and just say hi. Let us know where you're joining in from. Extra points for weird locations. Anyone from Humpty Doo? I heard that is close to Darwin in NT. I myself am based in Melbourne. If you have any questions for our instructor today, please pop it into the Q&A section, which is separate from the chat, so that I can look out for it and get our instructor to reply to you. Given that there will be quite a number of us online today, so make your questions super clear and easy to read so that I can understand it and then raise it with the instructor. And finally, the session is being recorded. Replays are available for VIP and team subscribers. Just for those that are new to us, let me introduce ourselves. I'm the co-founder and CEO of Tax Nuggets, and we're here to change the way accountants do their CPD and training. So we're a subscription-based, all-you-can-eat platform, just like Netflix, which means you get unlimited access to all our live events. This is just one of 3 that we do every week, and you get access to every single replay of every single live event, as well as resources. And we include programs as well, like our grad program and FBT program. We got monthly tax updates and special topics like today's session. And all our instructors are leading practitioners. There are no lecturers here. You get on-demand CPD reporting, and we do not like to do lock-in contracts, so it's pay monthly, cancel anytime. So if you're curious to dive deeper, head to our website, taxnuggetsacademy.com.au, or just Google us and check us out. So let me introduce you to our superstar instructor today. He's the managing director of Velocity Legal, and he lives and breathes tax, specializing in tax disputes and complex tax advice for private businesses and family groups. So please put your emoji hands together to welcome Andrew Henshaw. Hello, Andrew.
Hello, Joyce. Thanks for having me here.
No worries. Thanks for breaking our record of largest registrants. Already, lots online today. Almost 500 of us already.
It's all you, not me. It's all you, not me.
No. You got some star power going on there. So what are we talking about today?
Yeah, so we've got a pretty big agenda today. As you said, it's a masterclass in trust deeds, and specifically issues regarding reading the trust deed and things to really be live to. So in terms of an agenda, you can see it on the screen in front of you. Briefly be talking about tax agents and legal advice. The read the deed mantra will come up again and again, but I'll give some examples about where it goes wrong. I'll briefly talk about some fundamentals, but I'm assuming a fair degree of knowledge already about discretionary trusts. And then I'll talk about 10 specific things to look out for and some takeaway points. With any of this stuff, if you want more information, there is great information on Tax Nuggets already. And if you need something beyond that, that's specialized and individual, of course, by all means, you can contact me via Velocity Legal's website. Q&A, happy to take them during the session. I expect there might be quite a few, so I'll try to leave enough time to make sure we can answer some of those Q&As. And I'm happy to stay back a little bit after 1 hour if you want to have an extended Q&A session. All right, so in terms of the first point, I don't want to harp on about this, but it's worth just acknowledging the fact that there is a prohibition on giving legal advice for someone who's not a lawyer, essentially. It's not covered by the Tax Agent Services Act. And there's a case of Galea and Camilleri, which basically an accountant was giving certain advice. There was problems with the quality of the advice. They were sued by the beneficiaries of the estate. And the case talks a little bit about, well, where is the dividing line between legal advice and not legal advice? And it's really hard because as accountants, you're asked questions every day about discretionary trust deeds. Clients want, your distribution minutes. They want to, I want to change this, I want to do this. So it's a difficult line, but I guess when in doubt, probably, go on the more cautious side. If a dollar's a big earth, it's more likely to be a dispute. Those are sort of the guiding principles, I'd sort of say. The other one is, if you do it, make sure you get it right, because if you don't get it right, then you're going to be up for potential negligence, insurance implications, etc., not being covered by insurance. So
yeah, can I just say that the line that definitely not to cross is starting to make changes to the trust deed. I think that's definitely, starting to go into the realms of legal advice. But the rest, interpreting the deed and all that, that's a little bit of a gray area, I think.
It is hard because it might be, if you've got a particular wording, okay, it's not 100% clear. What does it actually mean? Then, different people have different views about, okay, is that legal advice or is it not? But yeah, you're right, Joyce. If you're preparing the documents, to vary a trust deed, then yes, of course, that's legal advice. Yeah.
Yep.
So this mantra you see all the time, read the deed. You cannot assume that two trust deeds are the same. It could be a new client. It could be a client you've had for a long time. They could have 10 different trusts in their group. You need to read the deed and understand what it says. It might be that they're all the same, but they could be different. And without actually reading it, you don't know. So every time you want to do something of significance, you need to go back and actually read the deed. And there's no shortcut for that, unfortunately. A lot of the older deeds are prepared on typewriters, and they look horrible, but you've got to read it. And the reason that someone's got to read it is because the trustee has fiduciary duties. And if they fail to meet those duties, there'll be breaches of those duties. And that could be most commonly an issue where you have a dispute in a family trust. So between children, for example, in a family trust. And one of the obligations, perhaps it's been described as the most important obligation or most important duty, is to act in strict conformance with the terms of the trust deed. So you need to read the deed and then act in accordance with it. So consider your obligations in context, the actual words used in the deed. If what you're doing isn't authorized, it's probably going to be invalid, which is going to lead to lots of adverse consequences. If you need to, get advice where is appropriate. So it's probably worth starting with, well, what if you get it wrong? What's the worst that could happen? And this is an example. We've got Bob and Bobby. They're the joint trustees of a family trust. They're also the primary beneficiaries. But the trust deed says ineligible beneficiaries include the trustees of the trust. And this is not that uncommon as a provision. So any distributions, purported distributions to Bob and Bobby, are not valid. You cannot make a distribution to someone who's not a beneficiary of a trust. That could have all sorts of flow-on implications, as in, okay, well, who pays the tax on the income? What if there's some estate planning or family law dispute going on as well? So typically sort of a tax and a control of the trust type issue. And if no one's entitled to money, of course, the trustee gets taxed at the highest marginal rate. So here's just an example of a trustee. You'll see these all the time. Usually all the most personalized parts of a trust deed, not always, but most of the time, the personalized parts of the trust deed are the schedule. They'll have the date, the settlors, trustees, name who's the specified beneficiaries and who's the additional beneficiaries. So I guess that's kind of the first place to look if someone's a beneficiary or not. Just having problems skipping. So okay, another case example, this is a real life example, is a case in Queensland from a couple of years ago. It's a really interesting case. It's called Benaroon and Lamar. So it didn't involve the ATO. It was essentially two people associated with a family trust. And this family trust had been set up in 1977. It had been set up by a Mr. Lamar and his wife at the time, Susan Lamar. Distributions were made to Mr. and Mrs. Lamar, and sometime later, Mr. and Mrs. Lamar got divorced. Mr. Lamar repartnered with Margaret, and then distributions again were made to Mr. Lamar and their new spouse. The only problem was that none of those people were actually beneficiaries of the trust. So neither Mr. Lamar or Susan or Margaret were actually beneficiaries of the trust.
Okay.
And the reason was because how the trust deed was drafted is essentially the primary beneficiaries were the children of Mr. and Mrs. Lamar, and then it sort of kind of cascaded downwards, if that makes sense, not back up to parents. So that's, you don't normally see that with a new trust deed, but with old trust deeds, I've seen that as well. So what the parties did is they actually sought a declaration from the court of what's called rectification to fix this issue, because they said, well, clearly we intended that these people would be beneficiaries of the trust. And over the last 45 years, we've made distributions to these people.
Okay.
Returns, financials, etc. And the court essentially accepted that Mr. Lamar and his first wife should have been beneficiaries of the trust, and that was so the deed could be rectified in that respect. So, but the issue was about Margaret, whether or not she could be, whether she was a beneficiary or not, or the court would order that she become a beneficiary. And there's a really interesting line in the case. What essentially Margaret appeared to be under audit from the ATO. And if she wasn't a beneficiary of the trust, she would be entitled to a refund. But if she was a beneficiary, she'd have a tax liability of nearly $8 million.
Yeah.
So, and presumably that's over a 4 or 5 year type period. I don't know the details because it's not in the case, but you can see what the stakes are of this sometimes when you kind of compound the issue because it's been done for so long. You know, if she's a beneficiary, she pays the tax. If she's not a beneficiary, somebody else pays the tax. Might be the trustee, might be somebody else. And essentially what the court said is we're not satisfied that there's enough evidence. Firstly, the parties had to go through the trouble and expense of this in the first place. But secondly, the court said, well, we're not actually sure that the parties intended to make Margaret a beneficiary. Because you've got to think, the trust was set up in 1977. Mr. Lamar and his first wife are together. Was it really intended that if Mr. Lamar got divorced, got repartnered, that new partner would be a beneficiary of the trust? And the bar for rectification is quite high. Essentially, you need clear and convincing evidence of your actual intention. So the court said, well, I don't know. We're not satisfied. So it failed, essentially. So you're not a beneficiary. Now, I actually don't know whether that was good or bad for the parties because it depends on who's going to get assessed and who's within time and who's not. Generally, a trustee is never, because a trustee usually doesn't get assessed, doesn't get a notice of assessment. The commissioner is generally not out of time to issue one to a trustee. So probably worse if she wasn't a beneficiary, despite being better for her, I guess. So there's a good example. I'll just briefly talk fundamentals very quickly, assuming most people know these concepts. You have the trustee, you have the appointor. generally the person who can remove and sack and appoint a new trustee, so essentially the real controller. In some deeds, you have a guardian, which is essentially a veto power on certain actions happening. You have the settlor, who essentially contributes $10 to the trust and does nothing else and is unrelated. The settled sum, which is hopefully actually paid. A lot of the times people write $10, the $10 is never paid. You've got the date that starts, the date the trust vests. You will have some sort of concept generally of a primary beneficiary. It might be described as a corpus or specified beneficiary. And then you'll have this wider class, which is described by relation, you know, the parents of Homer Simpson. You will have some excluded beneficiaries. You will have a power to distribute income, which is often clause 3. You'll have a power to distribute capital, which is often clause 4. You will hopefully have a power to vary the deed if you need to. And you'll hopefully have some sort of succession mechanisms about, well, what happens if we want to put a new appointor in, or a new guardian, or a new trustee, or what happens if one of those people dies or passes away, or loses capacity. So hopefully you'll have those things as a starting point. I guess that's, if you're picking up a new trustee, you probably want to tick off on each of those fundamentals and perhaps put a summary together for your file on you know, your trust deed.
And is it common, we've got a question here from Ben from the audience, and is it common for ATO to request for a trust deed during an audit?
Absolutely, yeah. It's kind of would be the first thing I think they'd really ask for, yeah. And I don't cover it in this, but I expect I'm probably going to get some questions about it. What if you lose the trust deed? And long story short is you're in trouble. Don't lose the deed. So I'm going to move on to 10 different sort of little subtopics, things that I sort of think are probably the most important things. It's not a definitive list, but these are sort of what I think probably the most pertinent issues when you're looking at a trust deed. So the first one is income, and defining income. Now, we've got two different concepts. We've got the trust law income concept, which is per your trust deed, so the income of the trust estate. And you've got your tax law income concept, which is your net income of the trust estate. So that's per the Tax Act. When I was a junior lawyer, it took me so long to get my head around the difference between the two. It's so confusing for new people into this area, but you've got these two different concepts, and beneficiaries are taxed on their share of the trust law income. Sorry, they're taxed on their share of the tax law income based on their share of the trust law income. And a lot of the mischief and problems with trusts come because these two concepts aren't the same. One is based on the trust deed and one is based on the Tax Act. Something might be trust law income, but not tax law income. And even if you have an income equalization clause, they still might not be actually the same things. So some of the differences between trust law income and tax law income, for example, the ATO has a ruling, it's still in draft form, and they say that, well, for something to be trust law income, it has to be a real accretion to the trust. So something that's a notional tax law fiction isn't trust law income. For example, a deemed dividend under Division 7A, a capital gain from a market value substitution rule, or an application of Part 4A, for example. Anything that the tax law deems as income, but there's not actually anything of substance behind it, that might be tax law income, but not actually trust law income. And it flips the other way as well. Trust law income is very versatile. Within reason, sort of almost, I wouldn't say anything, but there's a wide degree of flexibility about what is or is not trust law income. And essentially the primary source is to go to the trust deed. So what does the trust deed say about trust law income? Read the deed. Does it define income? What does it define income as? Or does it stay silent? So for example, if you have a nice modern trust deed, it might say something like, the income means, unless otherwise determined by the trustee, it's the net income determined according to ordinary accounting principles. So say basically, starting point is its ordinary accounting principles, but the trustee can determine otherwise. So that's quite a good provision. You might have a situation where the deed's silent. So it doesn't actually define income. Older trust deeds are typically in this category. And if that's the case, then income will take its ordinary meaning, which essentially is accepted to be ordinary concepts and accounting principles, basically.
So it wouldn't have a capital gain,
Yes.
for example. Yep.
Yeah. So one big thing is if it's ordinary accounting principles, you're generally not going to have a capital gain included in that definition of income. You might have a definition, and the two most common ones are, again, ordinary concepts, accounting principles, or income means pursuant to Section 95 of the Tax Act, which is what I referred to earlier as an income equalization clause. The intent is, well, we don't want them to be different, we'll equal them. But as I said earlier, even they're not always equal either. Ideally, what you want is a flexible one. So you've got the power for the trustee to determine what is income and some sort of deed if the trustee makes no determination. And in that case, the trustee can decide each year, is there some reason why we should define income some other way? What happened this year? Was there anything unusual? Was there a capital gain or whatever the issue is? You've got the power to choose what might be best for the family group. Just as an example, with a capital gain, if the income is defined as tax law income, then assuming the 50% CGT discount applies to the capital gain, then the amount the beneficiaries are actually entitled to is only 50% of the gain. So technically, if you define income as tax law income, you've got a capital gain. The actual amount the beneficiaries can call upon from the trust is just the reduced amount. The rest is essentially corpus of the trust.
Yep.
Now,
that's
that
huge.
might not matter.
Huge
Sometimes
difference.
it might not matter, but sometimes
Yep.
it will matter because it might be there's a 100A reimbursement agreement issue, or there's a family law proceeding about the present entitlements or some other issue. So it can make a big difference. So moving on to default distribution clauses. Now, the reason default distribution clauses exist is because we want to avoid a situation where the trustee is going to get assessed on any part of the income. And then, as we know, if there is income of a trust estate to which no beneficiary is entitled, presently entitled, then the trustee is assessed on that amount. So what a default distribution clause intends to do is it says, well, if the trustee has failed to make a beneficiary presently entitled, we don't want the trustee being assessed. We want it to go somewhere else. So most deeds will have a default distribution clause, and they say, well, if there's been a failure to distribute, then these default beneficiaries will be entitled. And in a perfect world, you never need this because everyone always does their trust minutes. They always do it before 30 June, and they've always accounted for all the income. But reality is that's not always the case. And there's a little hammer whacking the trustee for not making a distribution. And I put a quote in from a case called BRK. It involved some solicitors, which were Cleary and Hoare, and an accounting firm called Harts. And the court, this great quote, they were satisfied that no one at Harts, the accounting firm, read the pro forma documentation produced by the lawyers to see whether it was appropriate for the circumstances. Anyone who did read it would have realized that it wasn't appropriate for the trust it was actually used for. And unless the deed was in the same form as the pro forma documentation, then the documentation is meaningless. So not only read the deed, read the document, read the distribution minute if you're using a template, make sure it's actually appropriate for the situation. Because the
So they're saying that when they were drafting the distribution resolution, they didn't read the deed, basically, yeah?
Yeah, and they used pro forma documentation from some other situation that wasn't appropriate for the particular trust deed that they were concerned about. Essentially, they said they didn't make a distribution before 30 June. Gets worse than that. So with the trust deed in question, it did have a default distribution clause. But essentially what the court said was the default distribution clause didn't actually achieve what you wanted it to achieve. And the reason for this is it's a little technical, but I'll take everyone through it because it's really important. What the court said was, well, it has a default distribution clause, but the wording of the default distribution clause essentially means it doesn't kick in until after the end of the financial year. So the time in which you're making someone these default beneficiaries presently entitled is, 1 second after midnight. So, on 1st of July. So if you ask the question, were beneficiaries presently entitled as at the cutoff of the financial year, the answer is actually no. So the
That's a
trustee gets assessed.
bad drafting.
Yeah.
Yeah.
But
Yeah.
this is actually very common. This is
Oh
not,
gosh.
this is
Okay.
very common in trust deeds. What the court essentially said was it remained open to the trustee until the very last moment. And sounds like pedantic lawyer stuff, but I mean, this is what the court said as well. Until that very last moment, the trustee could have exercised the discretion. And it's only until the year ends that it didn't. And therefore, that's when the present entitlement's created. Meaning that there is a present entitlement, it just wasn't created in time. So disaster. What you want is, and this is an example of an older trust deed, one that I've found just came across my desk recently. If the trustee fails by 30th of June to exercise their discretion, then the income is set aside, essentially. Now, again, this is sort of problematic. Well, what does it mean by the 30th day of June? Does that mean the end of the 30th day? Or does that mean the start of the 30th day? In both cases, it's kind of a bit of a problem because it's like, well, if it's the end and you don't make it, you're in the BRK situation. And if it's at the start, well, most people date their distribution minutes 30 June anyway. So does the default distribution clause kick in before the minute, essentially? So you want to be specific. Ideally, in best practice is the trust deed will say there'll be a time in the trust deed. So it will say essentially, if the trustee fails by 11:30 p.m., then it goes this way, and it avoids the issue. So the tip there is check the deed, check the default distribution clause. If it doesn't have a time stamp in it, if it doesn't go into hours and minutes, it probably doesn't work.
Right. Okay.
Here's another example. This is a more modern deed as well. If you look at 3C, it says if the trustee doesn't exercise the discretion, then the trustee has to distribute that amount to the beneficiaries living as at 30 June. But if you go back to the start of the clause, it says if the trustee doesn't exercise the discretion, well, when? It doesn't even mention a timing. So it needs to say if the trustee doesn't exercise the discretion by 11 p.m., 10 p.m., whatever time you want. Moving on to the third issue, and I'll only talk about this one briefly, is streaming. So laws were introduced 12, 13 years ago that sort of made sure that trustees can stream franked dividends and capital gains to particular beneficiaries. So you get your franked dividend can go to your bucket company, and your capital gain can go to your individual, so they can use the 50% discount, for example. If you don't have streaming, you can't do that. What happens is just all the beneficiaries just get a slice of everything, essentially. And in order to stream, you need to make sure the deed has the power. So what you're looking for is some sort of power to specify categories of income. Most deeds have this, but not all deeds do. So whenever you're looking to make a beneficiary entitled to a particular amount of franked dividend or capital gain, you need to check that the deed actually has a streaming power. Because if it doesn't, it doesn't work. Some are drafted better than others, but so long as there's something, you're probably okay. This is an old deed what it says is any determination can specify a category and the amount of income from that category. I think that's enough to say, well, the category is franked dividend, and this is the amount from the franked dividend. Joyce, any great questions coming through so far, or shall I keep?
There are too many questions.
Too many to answer. Okay.
Well, I think I'll save most of them for the end.
Okay, I'll make sure there's a good amount of time for the questions.
Too many good questions, hard to choose. So
yeah. So one other issue that I've seen, and this is most commonly in Victoria, so apologies for those who aren't in Victoria. We're seeing a lot of in specie distributions, and so this might be an asset in a trust that's being transferred out of a trust. It doesn't have to be a real property. It could be something else, but in recent times, the driver that I've seen is it's real property. It might be a main residence. It's in a trust, and for either because they're getting pinged with really high rates of land tax, or maybe for a succession planning reason, we want to get that property out of a discretionary trust. So if you want to do something like that, or a client wants to do something like that, the first question is, well, do you have the power to do so? Does the trust have the power? Well, firstly, is the person a beneficiary? Make sure you tick that off. Does the trust have an ability to distribute capital, and what restrictions are there on distributing capital? Whose consent do we need? And does it have the power to distribute an asset rather than cash? The answer to these will usually all be yes, but you need to check and make sure. And whatever procedure there is in the trustee, just make sure you follow it. It's better being conservative on these things. If it says you've got to give 7 days notice to the guardian, for example, just make sure you give 7 days notice. It's not, not going to put anyone out, but it's going to make sure that no one's going to be able to attack it in the future.
Yeah, and can I just check, are there any tax implications on making, oh yeah, you're going to talk about duty soon?
Yeah, so in terms of tax implications, the beneficiary would become absolutely entitled to the asset, and you generally have a CGT E5 happen on resolving to make someone specifically entitled to a certain asset. So you'd have E5 happen. In addition, if you're transferring real property, you may have duty implications. Now, if you're lucky enough to be in the great state of Victoria, there is a duty exemption for transferring property from a trust out. In other states, they're not as generous. It's one rare instance where there's possibly less tax in Victoria than other states. Now, if you are in Victoria, you are looking at doing a transfer of property out. There is a duty exemption. It's very, very tightly looked at now. And the issue is that the transfer can't be for any consideration. And what we tend to see is a lot of the time there's beneficiary loan accounts, and the capital distribution will be done, and the beneficiary loan accounts will be offset at the same time. And if that's done, you essentially lose your duty exemption. If anyone's interested in this further, there's a VCAT case on this exact point. It's called Barlow. What happened is in the accounting records, they had the beneficiary loan accounts and they offset them at the time of doing the capital distribution. And even though the loan accounts were only $100,000 and the property was worth $1 million, you don't get any exemption at all. So it's not like a partial exemption. You lose everything. But one to watch out for. Moving on to excluded beneficiaries. So just like in Benaroon, someone's not a beneficiary, or they are a beneficiary, but then there's a clause saying that they're excluded. They fit within the class, but then there's another clause saying, no, they're excluded. The distributions are void. And in a modern trust deed, what you might see is something like this extract. The excluded class aren't entitled to any benefit. They're excluded from anything. You can't pay any money, you can't lend anything, you can't do anything, you can't exercise any power, variation, etc., in any possible way to benefit this excluded class. The reason behind these provisions is essentially you have to exclude the set law from receiving a benefit under a trust. And if you don't exclude the settlor from benefiting, the trust is technically a revocable trust. If you really want to be nerdy, have a look at section 102 of the 36 Act. What it says is the commissioner can essentially treat a trust as not actually being there if the trust is a revocable trust. So that's why the deeds exclude the settlor. But sometimes deeds go a lot further than excluding just the settlor. They can exclude a whole raft of people, and there might be reasons why. Sometimes there is no logical reason why. So, for example, this is quite a big list. It's the settlor, someone claiming in right of the settlor, a corporation which someone else in the class has an interest in, a trust which someone else has an interest in, and certain foreign persons as well. And I'll come back to the foreign person thing a little bit later on. One issue just to keep on the radar is a notional settlor. And some of you may have never heard of this before. So what's a notional settlor? I know what the settlor is. They contribute $10, but what's a notional settlor? And I've extracted a really ugly version because this is generally where you see it. You see this terrible photocopy, you know, part of it's black, part of it's white. You can barely read the words.
It's real life.
It's real life, yeah. And it says the settlor is the first one, the A, and then the second one is any notional settlor. And those people are excluded from benefit. And a notional settlor is generally defined as somebody who's transferred property to the trust at less than full consideration. They then are excluded. So if you've got this is huge, because this would cover any gift, any below market transfer, any interest-free loan to a trust, anything that's done not at market value would be caught by this. So, you know, you got your settlor that contributes $10, but the rest of the money in the trust had to get in there somehow. Those people would be excluded potentially under a notional settlor provision. So just beware if you see it. I've probably seen it sort of 1 in 100 trust deeds, but I do have one matter where I've got one right on my desk at the moment. So if you see it, just be live to it that it does exist. There are some strategies, but be live to it that it does exist. In some certain situations, you can actually vary the trustee to remove the notional settlor provision, which seems a bit unusual, but I've had one situation recently where the variation power allowed you to, or didn't prevent you from removing the notional settlor provisions. It prevented you from benefiting the settlor, but didn't prevent you from taking away that notional settlor power. All right, moving on to vesting. So what happens at a vesting date of a trust? Well, something like this clause happens. This is from the Grim and Grim deeds, which they're pretty common. You note them from these big, bold headings, and there's a very specific formatting of them. What the deeds will say is that at the vesting date, whatever the trust fund is held for certain beneficiaries in certain proportions. And that'll generally be the person's named in the deed as the corpus beneficiaries. And if one or more of those people aren't alive, you need to do a bit of an exercise in working out who takes their interest in their shoes, because in reality, probably who the corpus beneficiaries were, there's a good chance they won't be alive at the time the trustee is vesting, if a trustee is vesting. So, sorry, just clicking through it. So basically what happens when a trustee invests is the discretionary elements of the trust go away. It doesn't end the trust. All it does is vests the interests. So essentially, think about it as discretionary trust becomes a fixed trust. Now, I'm talking general, so you need to actually read the particular provision and make sure that's what it says. But most of the time, that's what it will say. And essentially, the trust can continue, but it continues essentially as a fixed trust. And there might be good reasons why you want to continue the trust. The reasons are essentially that vesting itself may not actually have tax consequences. And have a look at tax ruling 2018-6 for this. Essentially what the ATO says is the vesting of a trust may not necessarily result in any CGT event. And there's a bit more detail about it, but I'm sort of running short for time, so I won't go through that. One thing you can do is extend the vesting date. Potentially, you might come across a trust deed that has a 40-year or 50-year or 60-year vesting date, or it's tied to somebody's life. Check the vesting date. If it's less than 80 years, vary the trust deed if you can, essentially. Because once the trust deed vests, it's going to be very hard to extend the trust date. The ATO say you can't. There is at least one case where it's been done, but you're far better to extend the vesting date before the trust is actually vested. And that's the quote. So I'm going to talk about foreign trusts and in Victoria and also New South Wales. These foreign trust issues are really because of increases in state taxation. So if we rewind about 8 years, the state started to put these foreign duty surcharges on the purchase of residential property. And essentially, non-citizens, non-permanent residents, if they buy residential property, they will be hit with an additional duty on top of the normal duty. And those rates have gone up over time. In Victoria and New South Wales, it's now 8% on top of the normal duty. So we're talking at this stage like 14% duty. And the trouble is, well, how do we treat trusts? Because it's okay, okay, individuals is fine. You just look at, are they a PR, are they a citizen? They're either foreign or they're not. But it's hard with trusts because no one owns a trust. The beneficiaries could be really wide. So the states have had to try to work out, okay, what kind of trusts would be foreign and what kind of trusts wouldn't be foreign. The upshot is assume the trust is foreign until you've satisfied yourself that it's not foreign. Is essentially, that's how I'd practically approach it. So if you've got a client that's buying residential property, assume that the foreign purchaser surcharges will apply unless you've read the deed and satisfied yourself that they don't apply, or entirely carve out any possible thing on the topic, but better to be sort of proactive on it. So in Victoria, we've got, it's called FPAD, Foreign Purchaser Additional Duty. It applies to foreign trusts. A foreign trust in Victoria is any trust that a non-citizen, non-PR, or another company or another trust has a substantial interest. And a substantial interest is 50% or is determined by the commissioner. So it really can be anything. And the person's percentage is the maximum amount of capital that the trustee could distribute to them. So basically, if it's a beneficiary and they can receive a capital distribution, their interest would be 100%, unless the deed doesn't allow 100% of a capital distribution to go to them, for example. The SRO, the State Revenue Office in Victoria, had a practical approach and said that, well, look, I know, these provisions were intended to cover foreigners, and look, if technically someone could have benefited, but they didn't, then we'll kind of look the other way a little bit. We'll bend it a little bit. That's 4 years ago now. So
That's gone.
That's been and gone. You can't rely on that anymore. You need to read the deed. So prior to trust acquiring property, if it's Victorian residential, firstly, is it existing trust? If it is, read the deed. If it's a new trust, make sure the deed's set up correctly. Read the deed. Usually the class will include at least one non-citizen or non-PR or some other trust that doesn't have, because almost like other trusts will be beneficiaries. So there'll probably be some way that someone that falls within that foreign person class will be a beneficiary. If there is, vary the trustee and do that before property is acquired.
Mm-hmm.
Do it afterwards, doesn't do anything.
Yep. And have you seen many audits around this area.
Yeah,
Yeah.
increasingly so. Yep.
And it's easy to audit, right? You just trace all the property
Look
exchanges
at
and settlements.
all you need to do is look at is it a residential property and is it acquired by trust?
Hmm.
I mean, you might have further information that actually made distributions, but that's all you need. And that information is readily available because when you do a settlement, it's all there.
It's huge. Such a big revenue driver for the
Absolutely.
SRO.
Yeah, and there's land tax as well, and the rules there are different. So we've got, again, foreign trusts for land tax. If they get hit, it's 4% additional land tax per year. Now, for land tax, it's based on who the specified beneficiaries are. So not the whole class, just the people listed in the deed. Now, normally that will be less of an issue because hopefully those people listed in the deed are not non-citizens, non-PRs, etc. But you can have weird deeds that do strange stuff. So I've just put in two different excerpts from recent deeds I've looked at. The one on the left with the blue, Mr. and Mrs., their children and grandchildren are all primary beneficiaries. So it's not just two people. You've got to ask the question of all those people, are any of those, do any of those fall into the category? And then this other deed on the right that I saw recently, Mr. and Mrs., children, grandchildren, and related entities for some reason are primary beneficiaries. So that's unusual, but again, you read the deed, don't assume anything until you've read it. If you're in New South Wales, you have these issues again, but the law is different, and essentially it's stricter in New South Wales. If it's residential property in New South Wales, there's two requirements, and they're strict requirements. There has to be no foreign beneficiary at all capable of benefiting. And then on top of that, you cannot amend the deed in any way to allow the foreign person to benefit. So not only do you have to exclude them, you have to make sure it's irrevocable.
Yep.
It's stricter than Victoria. And just to give a quick case of how this is applied in practice, this is a recent decision. In this case, a trust was set up in 2022. The family got a lawyer in South Australia to draft the trust deed, and the trust was buying property in New South Wales. The lawyer in South Australia did not include any restrictions on foreign persons, and they got audited. And at the time they got audited, after the time they got audited, they entered into a deed of rectification, the parties, saying, look, our intention the whole time is to go back to the very start. We never intended to, we didn't know about these provisions, but we intended not to benefit any foreign persons, essentially. That was accepted as valid going forward, so for each year-on-year land tax. But the court said, we don't buy it. Firstly, we don't buy it because no one was aware of the issue at the time. The fact that it results in a bad tax outcome isn't what you need for rectification. And even if rectification works, when the revenue officers have to assess something, they have to assess it as at the time of the things that are there, essentially. So in other words, it's going to be almost impossible to retrospectively fix these problems.
Andrew, how do you determine where the trust is like domiciled or which jurisdiction applies?
Yeah, usually there'll be a governing law provision. There's about which state sort of the law is based on. It can get a bit messy when you got real property though, because what happens with real property is the governing laws of wherever the property is located are the ones that are going to supersede whatever the trust deed laws are. So, you could have drafted the trust deed with the governing law being South Australia or Queensland or in some other jurisdiction, but here the property is bought in New South Wales, so it doesn't really matter where the trust was located. It's about,
Understand.
Yeah.
Yep. And can I just check, this foreign purchaser additional duty, FPAD, only applies to residential?
Generally residential, yeah. So the absentee, some of them do apply to commercial property as well, depending on which one you're talking about and which state. But most of the time it's just residential property that's covered. Or something that, and be careful because some things could be like quasi-commercial. It might be like a boarding house, or there's that line also between what's residential and what's commercial as well.
Yep. I say the key takeaway is anytime there's a property in a trust or you're about to purchase property in trust, just get a lawyer to look over it, I think.
Yeah. Particularly if you're in Vic and the property's in New South Wales, or you're in Queensland, the property's in New South Wales, and particularly if it's outside your jurisdiction, and that's where to be even more careful.
Does FCAT apply to farmland?
That's a good question. I think that it does. Yeah. Assume that it does until you can satisfy yourself that it doesn't.
Yeah, to be safe.
Yeah. So I'll move through these two last issues pretty quickly because I want to make sure that I can answer the 100 questions that are here. Varying the trust deed. If you want to vary the trust deed, read the variation power. What does it exactly say? And be very careful with the wording. So this deed here, you need to have the written consent of the appointor. So work out who the appointor is and get their written consent. Hopefully that's not an issue unless there's some sort of dispute and you've fallen out with the appointor or something like that. And then work out what you can actually do. So this one says you can alter, vary, or revoke any trust or provision here under. And the second one is resettling the trust. So if you were deleting a provision, that would probably be covered because revoke and deleting are the same thing. Arguably, if you wanted to add a new clause, maybe you can't do that because it says alter, vary, or revoke any trust. Is adding a new clause altering the trust?
Oh my God, that's so pedantic.
It's so pedantic, but you could fix the issue by varying the variation power. And the variation power can let you do that. But if it goes to court, if someone's looking at it, they will be pedantic about it as well. Another issue is about the schedule. Sometimes what you want to change is a detail that's actually in the schedule, as opposed to the 30 pages of the deed at the front. Make sure the deed actually allows you to vary the schedule because some deeds don't. This deed does. So in that third last line, it says including the schedule and the annexure. But look above in the second line, it says the trustee may at any time before the vesting date and with the prior written consent of the appointor. So arguably prior written consent would mean not, because normally when the variations are done, you get the appointer to sign the deed of variation as well in the same document. I mean, maybe that's okay, but probably the best practice is to actually make sure that the consent has been given essentially before the variation is done, not at the same time. Again, super pedantic, but do you really want to open up, those arguments? Probably not. And you might even have a situation where there's essentially an inability to vary the trust. Sometimes an issue I've come across is some deeds will require the guardian to consent to a variation, and they'll say if there is no guardian, you don't have the power to vary the trust deed. Again, another one to watch out for. Final of the 10 is about passing control. So there's a number of ways that you can pass control of a trust. You could change the trustee, the appointer, shareholders of the trustee if it's a company, the directors of the trustee if it's a company. You might want to exclude beneficiaries because you're passing the control to certain people and you want to exclude others. Or you might actually make wholesale changes to the trustee. You might change corpus beneficiaries, things like that. With all of these, read the deed. Other than changing the shareholders and the directors of the trustee, which is not a trust law concept, make sure you can do it, follow the process, and make sure you understand the tax consequences as well. In general, if it's the same trust and it's not a new trust, and you've got the power to do so, you shouldn't have CGT or stamp duty consequences in general. And advance holdings, you don't want to read it. What happened there is that they tried to appoint a new trustee of the trust, but what they did is they tried to add an additional trustee. Essentially, how the power in the trustee only let you remove a trustee and then replace a trustee. It didn't actually allow you to add a new trustee. So they purportedly added a new trustee. It was invalid because the power only allowed the removal and the appointment, not an adding of a new trustee. Again, I guess the takeaway again is be pedantic, because these are how these things are interpreted. If it doesn't have the ability on the words, you're going to be out of luck most of the times. Yeah, read the deed, print the deed. If you've got Adobe, you can use the text recognition, which is usually pretty good. So you can search for terms, Control F, notional set law, Control F, whatever it is. You can look and you can do, it's not a substitute, of course, for actually just reading the whole thing, but it's a good starting point to say, hey, these things in there or not. So you consider the actual words used. If there's a problem in the wording, just be aware it's going to be very difficult to rectify that. Not impossible, but difficult. Risk of invalidity of actions, and seeking advice where appropriate. And one more time, read the deed.
Read
Sound like
the
a
bloody
broken record
deed.
at this point. Joyce, I'd like to open up to your best questions.
Yeah, just before we do that, while we still have people here, if you can just, if you enjoyed Andrew's session today, please come to his session in a couple of weeks' time, federal budget update. It's going to be a really, really good one. I don't know if you heard any goss about it, Andrew, or is it just going to be a fizzer?
Well, look, I mean, there's been a few sort of dull ones over the last few years, so maybe it's time for some more things to come up. I mean, there's been a lot when nothing's happened. So, for example, Division 7A, there's no updates. There's rollovers, CGT, small business concessions. We don't know. You know, we know that it's yeah. Well, let's see, and come along. It's a free update.
Come along. It's on the
nothing
15th
to talk
of
about.
May.
You know, I'll humor you with jokes for an hour. But there's always things.
Assistant Nugget just popped in the link to our live events page where you can check out all our upcoming events as well as few free events like this one. And then if you found value in today's session, check us out, taxnuggetsacademy.com.au, and we'll head to Q&A now. Interestingly, Andrew, you were mentioning about, print the deed, if it's in PDF, you can do, text recognition. Have you ever used ChatGPT before to sort of, I don't know, read or interpret the deed? Someone has just asked, can they use ChatGPT as a starting point to read two deeds and say, for instance, search for differences?
That's a good point. You probably could. I mean, I've enabled Copilot on my Office 365, and I've had varying degrees of success with it. Try it and see. I'd be interested to see the results. I think the problem is that, like in the deeds, a lot of this, like you have pages of different powers of the trustee. The trustee has the power to do 400 different things, and all the stuff around that, it's probably, you don't need to know that sort of stuff. It's only, so yeah, try and see.
But just keep in mind that ChatGPT is not very secure, not very private, as compared to Copilot. I think Copilot's safer.
Yeah.
And before we get into the next question, we've just launched the ratings poll, so please rate us. Let us know what you thought of this event, and also comments and suggestions are very much appreciated as well, so that we can improve. Jaspreet has asked, can friends create a discretionary trust, or should they create a unit trust?
Well, it really depends on the purpose, I guess. Usually a unit trust is used to own, most commonly, property where there's unrelated, like non-family member parties. So you got two friends who come together. and they want to buy a property. They don't want to use a company because the company will be taxed completely differently. They can't really use a discretionary trust. Like, you could draft one to include two families in one, but you're going to have problems if you ever wanted to make a family trust election. You're going to have problems possibly from succession, things like that. So, and you probably need someone to draft it bespokely as well. So you're probably much better off just saying, yep, each of the two unit holders have their own family trusts, and there's a unit trust set up. Yeah, unless you want to get really creative, but clients probably won't pay you for that.
Okay, we got quite a big question here from Aditya about the income equalization clause. So doesn't the income equalization clause lead to a circular provision if the income of the trust estate is lower than the tax, like the net income under Section 95?
Yeah.
And then he said, would the income equalization clause be better if we put an if in there? So like, to use it only if net income is lower than,
That's a good
income of
question.
trust
So
estate.
few comments on that. I don't like income equalization clauses, and I'm not the only one that expresses that opinion. So I usually prefer not to use them, and just use something that's certain. The issue that you get into is circularity. It's like, well, you don't actually, it's kind of the same issue as the BRK default distribution thing. Until the end of the income year, you don't know what the income is, because until the last second, you could have some massive deduction. So therefore, it's kind of like a circular, like, is it ever certain? And then if you want to be careful about conditionality, about if this, if that, because there is cases where they say that essentially it's not effective. You need to be able to work out with precision, like before the end of the income year, what the entitlements actually are. You can express it as a percentage still. It doesn't have to be a dollar figure, but it has to be able to be ascertainable essentially. So yeah, be careful with that. What I've done before is I've said I've essentially done income equalization clause, but I've changed it slightly to say it's the tax law income up until 11 p.m. at night. So like that there's a cutoff. Again, it sounds pedantic, but
there is certainty.
Yeah, there is certainty before the end of the income year on what it is.
Okay, still on the topic of income equalizations. Oh, no, sorry. This is more about where the trustee can determine what income is. How would you express that? What is classified as income in the distribution resolution? And is there, a common approach? Where flexibility is allowed?
I usually use sort of like determined with ordinary accounting principles. And then if there's something else you want to add in, just specifically add it in. Say, essentially, the income is this plus the capital gain, for example. Or you might say, well, I'm just going to stream the capital gain, so I'm not going to worry about defining it as part of the
income.
Well, sorry, actually, I'll take that back. To actually distribute something, it still need to enliven the income power. So it has to actually either has to be income or it has to be capital. You have to have a power to actually distribute it in the first place. So yeah, I would either take ordinary accounting principles or that plus something on top of it.
Okay. And you knew you were going to get this question, Andrew. What should we do if a new client comes on board that has lost the trust deed and have no clue where to go? It's definitely lost. It's gone. Can't find it.
I think you've got to assess firstly. I'll come to the actual answer, but I think you've got to assess firstly, what assets does it have? When were they acquired? Any pre-CGT? Is there big increases in the cost base? Is there any possibility of any falling outs in the family or stress or tension or things like that? Because if there's any of those, then you've got to be a lot more careful. So the technical correct answer is the trustee needs to go to the Supreme Court and seek an order for like relief essentially on what to do. Because how can a trustee administer the terms of a trust without knowing the terms of the trust? Your worst case scenario is the trustee gets sacked by an aggrieved beneficiary because they're asking, where's the trustee? Where's the trustee? And they can't provide it, and essentially say, well, you failed in your duties, you haven't gone and sought orders, etc. But in terms of more practical things, search everywhere. Is there a photocopy? All that sort of stuff. I have assisted in doing sort of deeds of confirmation, which is essentially the trustee and all the beneficiaries essentially getting together and saying, these are the terms, and we're signing that. What value and what protection you get from that document is probably debatable, but it also depends on who's knocking at the door as well. Like, who's going to agitate? What are they going to agitate on? If everyone signed the document, you're probably not going to have a family dispute over it. If it's the tax office, I mean, what would their reason be? Maybe to say, well, the trust doesn't exist anymore, or it's a resettlement, or that property was never pre-CGT, and you'd have to provide enough evidence to say, no, all the tax returns are lodged, and all that sort of stuff. So it is still the same trust. Hopefully that answers the question.
Yes, I think it does. I think your initial answer during the webinar, you're in trouble, sums it up well. We've just launched another poll. Can you let us know, please, where did you first hear about us? That'll be very helpful for us to, spread the word a little bit more. So thanks very much.
One or two more questions? Yeah.
Can you stay maybe another 5 more minutes?
Yeah, sure.
Andrew? Yeah. Thank you. Next one is from Bradley. I think it's kind of more of a statement. So you know how you like to do your, trustee has to determine the income by 11:30 p.m. Is that why some old trust deeds, say that the trustee must, do something by the 29th of June?
I think probably, yeah. And I've even seen earlier dates. I didn't actually include this in the presentation, but I've seen like the 28th of June as well. And the risk is if you don't read those and you date your distributions on the 29th or the 30th, again, they're not valid because it's going to be done before that date.
Yeah. Amazing. Next question is from Angel. So I understand that the trust is required to prepare the distribution resolutions before or by 30 June, 11:30 p.m. or whatever. But when does the distribution actually need to be paid? Is it right after the tax return has been done? This is such a 100-day question.
Oh, look, I'm happy to answer it. So the first thing is you don't have to document the minute. You should do it anyway, but you don't have to document the minute by 30 June. The directors need to resolve to make their distribution. There is nothing stopping the directors from convening a meeting and essentially saying, oh, I met on, the problem is if it doesn't happen. But in theory, the directors could meet on the 30th of June and say, we're resolving, 50% go here, 50% go here, whatever. And then that actually be formally documented in a minute later on. But nothing's stopping that. Question is if it actually did happen or not. Secondly, if you're streaming capital gains or franked dividends, I believe it has to be documented within 2 months of the end of the financial year. To go to your actual question about when it needs to be paid, there is no requirement about when it needs to be paid. All that needs to happen is the beneficiary needs to be made presently entitled by 30 June. Presently entitled means that they have the right to call upon the money. They may not exercise that right. Because this is how it works, this is why there's issues in trust law, because all you have to do is create the entitlement. You don't need to pay it. And that's why you get things about is a UPE, DIP 7A loan, 100A, all this other stuff, ATO's guidelines, et cetera. For what it's worth, the ATO guidelines say, I think you're low risk if you pay the entitlement within 2 years. But there's no law in that statement. So there is no requirement to pay it within a certain amount of time.
Yeah. And also, watch, the Bendel case closely, because that will be very revealing.
Yeah.
All right, I'm going to choose the last couple of questions. There's so many good ones, but I'm trying to give a bit of a variety. And let's choose like a succession one that I saw. I can't remember, but somebody asked like, which one takes precedence, the will or the trust deed? Oh, yeah, I found it. So what happens if a will has been made separately to the trust after the trust was created? Can it override the provisions of the trust?
Good question. So if you're looking at the estate planning, firstly, just be really clear what you're actually looking at. So a will generally covers assets owned by an individual, so not assets that are trust property. You might have beneficiary loan accounts or unpaid present entitlements. So as in the trust has a liability to pay money to an individual. That is property of the individual. So if that individual has unpaid present entitlements or loan accounts, that will be dealt with as part of the will. The trust assets sit separately to that. The trust assets cannot be dealt with in a will. I've seen it, people try to do it, but it can't be done. What you might see in the will is provisions around the passing of control, because what the trustee might say is the appointor is Joe, and then it's the person nominated by Joe or as specified in Joe's will, for example. So if you see something like that, then well, the will specifies that the new appointer will be someone else, and it won't override the trust deed. It's consistent with the trust deed. So I guess to answer your question, the trust deed will override everything else. Always start with the trust deed, but there might be a linking between the two, because the trust deed might say, if you do something in your will, then that will be relevant for working out what happens under the trust deed.
Amazing. I love all your answers, Andrew. It's like poetry. All right, one last question. Oh my God, there's like almost 20 more that we can't get through. But I don't know, I'll chat to our learning team and see if we can get you back for like a AMA session, Ask Me Anything session. But just so you all know as well, Andrew will be coming back and doing more like trust law and trust, type. Yeah, a whole series, one every month, I think. And the next one is like how to prepare trust resolution. That one's, so if you check out our live events page, you can look that up. One last question from Amanda. So about the CGT discount and income. So I think this is the situation where income is taxable income, and there's a CGT discount, and so only 50% goes to the beneficiary. What happens to the other 50%? Does it stay in the trust?
Yes. Well, the answer to that is yes. It stays in the trust because it becomes essentially part of the trust fund and it becomes part of corpus. So I think from an accounting perspective, you have to do an equity increase. And to get that money out, I mean, you could lend the money or you make a capital distribution of the money.
Okay.
Which it might not be an issue. It's just doing the paperwork and the documentation right. The other related thing to that is you might have a situation where you are claiming the small business concessions in a trust, and there might actually be no taxable income at all. So because the taxable income, let's say the 15-year exemption applies, then the taxable income will be reduced to zero. And let's just assume for a second there's no other income that comes in from any other sources.
What do you do?
You have no income. And for the small business concessions, you generally need to make a distribution because you've got to trace through and all that sort of stuff.
Yep.
So it's another reason why using an income equalization clause would be a problem there. If you specifically define the income and included the capital gain by whatever means, you'd make sure that you would kind of avoid that issue, I guess.
Understand. Yeah. Which is why, all the deeds that the deeds that were, the modern deeds that we shown today were mostly from Velocity Legal, the good ones. And I think your default was ordinary accounting principles, yeah?
Yeah.
So Amazing. I think that's all the time we have left. Thank you so much, Andrew, for staying back another 15 minutes, taking time out of your busy day to educate us about the pedantic world of trust deeds. Oh my God. Yeah. And just before we go, yeah, one last thing, what's your number one key takeaway from today? I know what you're going to say, but let's do it anyway.
I think it's going to be raid the deed.
Darn it. I wish you said something else just to like prove me wrong.
I should have said something else just to pretend you weren't listening to anything I said.
But I think it really sums it up well. Like just the whole thing you went through today, how many things could go wrong, and like the last one you chucked in about the small business CG concessions, like that is just, if you don't read it, then you're gone. Yeah, you potentially even fail the CGT eligibility criteria. So thank you
everyone for joining. Thanks for all joining. See you in the next Tax Nuggets episode.
All right, everybody, please put your emoji hands together one last time to thank Andrew Henshaw.